Global Insights with me, Punita Kumar Sinha. Over the last 2 episodes, we have analyzed the end of quantitative easing in America and its impact on different asset classes, including emerging markets. Today, we delve deeper to see which of the emerging markets will stand out as winners in the coming months. But before we do that, here's a sneak peek into the performance of these markets over the last 5 years.
When Goldman Sachs coined the term BRICS in October 2003, Brazil, Russia, India and China were the fantastic four in the making. 11 years later, those projections seem not just a bit far-fetched, the very existence of the celebrated acronym BRIC is under threat. The BRIC cluster was the face of what we've called emerging markets for the last decade. A bunch of nations on the same cusp, ready to launch into advanced development trajectory. But then, tremors and aftershocks from the global economic crisis of 2008. The resultant shake-up derailed many of these economies. The most recent quarterly GDP growth in China is at its worst in 5 years. Brazil's currency is at its weakest in nearly 9 years. High inflation and massive budget deficit have marred the prospects for Brazil. And the leftist Dilma Rousseff's victory in the recently concluded elections has only aggravated fears about the economy. On the other side, Russian currency's strength is at an all-time low. Oil prices are staring down the barrel, worsening the pain from geopolitical tensions and the standoff with the West. It's the worst time in Moscow since the end of Cold War. India also has its share of woes. High deficits and inflation, weakening currency and a slump in manufacturing leading to a sustained decline in GDP growth over the last few years. So will these economies still emerge as winners in the long run? Can they still be spoken about in one breath? If not, where can investors bet their money and which ones should they steer clear of?
Well, clearly, India has been a rank outperformer. But be it the BRIC cluster or the Mint or the Fragile Five, each country is being evaluated on its own merit. Let's discuss how each of these emerging markets are responding to the global issues and what it means for investor returns. Joining me on the show today is veteran market speaker Jim O'Neill, former chairman Goldman Sachs Asset Management, and Teresa Barger, CEO Cartica Capital, a specialist fund investing in emerging markets. Thank you both for joining us today. Jim, let me start with you. It appears that the impact of tapering on various emerging markets will be different. So should emerging markets be treated as one asset class going forward?
Well, I've believed for many years that people shouldn't talk about emerging markets as one asset class. It sort of seemed ridiculous to me for actually maybe even 13 years, go back right to the days of creating the BRIC acronym. That's partly why I did it. And if you look at how what other people call conventional emerging markets this year, you can see, I think the Shenzhen equity market in China is up 28% year to date, one of the strongest, if not the strongest performing market in the world. And it seems to be completely unaffected by some of the issues which affect other emerging markets. So, you know, the time has long gone since when people should be referring to all of these as one asset class, and yet the habit persists. I guess people in conventional finance are slow to change.
And Teresa, what do you think? IFC coined the term emerging markets, but they no longer behave as one asset class. So should investors look at single countries instead?
Well, let me take that in 2 parts. First of all, I do think that it makes sense to have an asset class called emerging markets, and those are countries whose stock exchanges are sophisticated enough to be fairly well functioning and dependable, but whose countries do not have a deep institutional base to make the countries themselves completely reliable on all fronts, including the legal, the regulatory, and the political. And then part 2, yes, absolutely, one needs to differentiate among the emerging markets when making investments, because over periods of time, they all have very, very different internal dynamics, and one must absolutely take that into account.
Teresa, I want to ask you about foreign debt. Morgan Stanley has said that foreign debt in emerging Asia has soared from about $300 billion to about $2.5 trillion over the last decade. So could we end up in another Asian crisis type scenario?
Not really. As far as I can tell, and I'm not a fixed income specialist, The most of the debt incurred in the Asian countries is local currency debt, which is very, very different than the situation in 1998, where most of it was foreign currency debt. And a lot of the new issuances, even in the frontier markets, have been in local currency. So I think we're in a very different situation than we were in the Asia crisis years.
Jim, would you agree that emerging markets are set for a slower growth, and so should investors expect lower risk-adjusted returns than in the past?
I don't agree with that premise either. I certainly don't think all emerging market economies are slowing, and some of them that are slowing for different reasons. If you look within the BRIC countries, yes, Russia and Brazil have been extremely disappointing the past 3 years, but it's primarily because of declining commodity prices, and they need to reduce the dependency on them. You look at India, I am extremely positive about India under Modi, and I think their growth is in the process of accelerating. China has slowed because China has deliberately slowed the growth rate to focus more on quality. If you look at some of what I call the next 11 largest emerging economies, it's quite clear that growth in some of them is accelerating, Indonesia being a good case, and of course some of the African countries. I don't think that premise is, the underlying premise is again really true. And of course, if you look at the markets of many of these places, many of them are showing 20% plus returns year to date. And I think in some cases that could continue, so long as US interest rates don't rise too sharply when they start rising.
Teresa, turning to you, how do you see growth panning out for emerging markets based on your bottom-up work?
Oh, well, first of all, we expect that the growth in emerging markets would slow down as the economies get larger, because as they get larger, they start from a higher base. So, of course, just I think naturally we're going to see a slowdown there. We also know another thing from very robust academic research, and that is that there is no correlation between stock market performance and the GDP growth of a specific country. And so there are, of course, certain industries whose revenues tend to grow at a certain multiple of GDP growth, et cetera. So you can't necessarily get away from it altogether. But we do look for countries whose companies can give us high earnings per share growth.
And Teresa, what is your view on valuations?
Well, actually, I think we would say if you're looking across the board, valuations are kind of cheap in the sense that emerging markets are trading at a PE 40% less than the US, and also 2 standard deviations below their normal compared to fair value. So there are some markets that are more expensive than others, but as a general matter, the EM asset category, I'm not sure that I would go along with saying that it's expensive as a whole.
But you know, wherever there is growth, valuations are already quite high.
That can be true. We've also found that the last few years we've had a challenge to the normal view of value investing, the Columbia University, Warren Buffett view of value investing. So for example, in 2010, 2011, if you invested in a very expensive PE consumer company in India, it got more expensive. So actually it was a value play to buy companies at 24 times PE because they went to 34 times PE. So you, I think, have to be a little, think 2 or 3 times deeper when you're applying value investing methodology to the emerging markets, because there are certain sectors at certain times where you can get this effect of expensive companies becoming more expensive. It won't always hold, but does sometimes hold.
So Jim, since both of you are still generally positive on emerging markets, within emerging markets, would you favor exporters given the strength in the US or countries with strong domestic consumption?
Very clearly the latter. I think the major story of our generation economically is the rise of the consumer in the so-called emerging market countries. And I think that's a major strategic development. And I would, and I do that a little bit with my own personal capital. I would favour very much investments in those, whether it be via some of those companies in the emerging world, or through Western branded companies that do particularly well there with their brand names.
Teresa, I just want to change the topic a little bit. You are activist investors who invest in companies with good corporate governance. So according to you, which countries have good corporate governance and which don't?
Well, I would a little bit divorce where we see opportunities from where it's good, but I think when I look around the world and say, where is the corporate governance good? Within the emerging markets, by far the best country is South Africa. And when I look at, I think a lot of the Latin American countries are pretty good on corporate governance, and a lot of them have worked to make that better. Brazil would be an example, with a Novo Mercado being the sort of good governance segment of the Bovespa Stock Exchange. Where we don't like corporate governance, I would say, if I can go out on a limb, the worst is China. And then to be a little shocking, the second worst would be Korea, although they are working on their dividend policy, which I think is a very good thing. And then the third worst would be Turkey, and I know many of my Turkish friends vehemently disagree on that. But we are just amazed by the how normal related party transactions are in Turkey.
And what do you think about the corporate governance in Indian companies?
You know, this has been an issue, and to be very honest with you, because I actually don't know any other way to be, when we look at companies, any company in the world, when we've chosen our country, then we've chosen the kind of companies we like, the first thing we do in looking at a company is to look at the integrity of the controlling shareholders of that company. And I have to say, Punita, I'm sorry to say, in India, we treat everyone as guilty till proven innocent. Not that there aren't fabulous groups, and of course we love working with the fabulous groups. We've been with Mahindra for 4 years in an investment there, but we take this very seriously. And so I would say in India, there is a wide variety of the kind of integrity we're looking for, which means that a controlling investor will treat minority investors just as fairly as he or she would treat his own family.
So if that is the case, why do you have 20% of your portfolio in India?
Yes, we have actually a little less than 20, but getting on 20. To explain it, I would say we like India, we don't love India. But there's not a lot to like in the world. Certainly among the BRIC countries, India is what I call the cleanest dirty shirt. You know, when you've been traveling for a week and you only have 5 shirts, and at this day 7 you say, what shirt should I wear? Okay, well, this one is the least dirty. And that's clearly true. Brazil is broken, Russia is a disaster at the moment. China is a very difficult time changing its entire economic model. And so for the BRICS, clearly India is the cleanest dirty shirt. And we also think India can reform and grow at the same time, similar to what Philippines has done.
Teresa, Jim likes the consumption theme in emerging markets. What is your view?
We like the consumption theme in the emerging markets, and we are invested in it. But, you know, we also have to make sure that we like the integrity of the companies that we're in. So we have to find companies of high integrity that are in the mid-cap space and whose price we like and where we think we can add value. So it's kind of a big order for us. So we just haven't found the right company at the right price to make that play in the Philippines. We are in Security Bank in the Philippines, which in a way is also a play on the Filipino individual. So we're playing it that way. But in general, we would agree with Jim, depending on the price.
As we've heard, both Jim and Teresa do not believe in looking at emerging markets as a single block. Both of them see pockets of opportunities within these emerging markets, and India is most certainly one of them. We will take the discussion forward with Jim and Teresa after this short break. Stay with us. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. Before the break, we were discussing the differentiating factors between the emerging markets. In this segment, we will see which one of these stand out as a preferred bet for foreign institutional investors. Jim, let me start with you again. Are you satisfied with what you're seeing in India in terms of inflation, growth, and reform?
You know, I am very bullish on India. I had the pleasure of meeting Mr. Modi a couple of times in the early days of when he was standing to be the leader of the BJP party and to become India's Prime Minister. And I was quite impressed with his focus and determination. And I think it gives India the best chance of delivering on its potential that we've seen in my 33 years of professional life. And I think the sell-side consensus is going to revise up its growth forecast for India. And I think we're in the reasonably early stages of India being re-rated. So I remain very positive.
And what do you think of the valuations in India and China? The companies with the best growth prospects look like their stocks have already performed.
I think China's still very compelling. It's cheap. India, on conventional criteria, does not look cheap because it's rallied so much and it didn't fall that much in the first place. But I think if we have the consensus starting to revise up its macro view and its forecast of GDP, it wouldn't surprise me people start talking about 7 to 8% growth again in India. Then you're going to get a whole revision of the basis and the denominator for the multiples. So I think India could be continue to be re-rated, although it does not look conventionally particularly cheap.
Jim, another question I have for you is that amongst the mint, you said in an article that you like Mexico and Indonesia, but you do not like Turkey and have mixed views on Nigeria. Why have you changed your views on Turkey?
Well, on Turkey, I think it goes back to this dependency on capital inflows and vulnerability to US interest rates and the dollar. Of all the brick and mint countries, I think Turkey is the most vulnerable because it has these persistent, rather large current account deficits and a huge dependency on hot money related to US rates. So that's the prime reason of why I don't like Turkey, along with the fact they don't really seem to be going down the path of reform. I think faced by a very complex environment around the country, especially to the south, of course, but also with the internal politics, the leadership appears to have sort of dug its heels in and resisted going for economic reforms. So I think the current environment for Turkey is basically a bet on US interest rates. In Nigeria, I say mixed because every time I go there, and I've travelled there a lot in the past year or so, it's so exciting a place and there's so much dynamism and entrepreneurial spirit. And the growth of the application of technology there is fantastic. So that excites me a lot. But of course, as is well discussed, the country suffers from a lot of internal troubles with battles to do with Boko Haram and enormous challenges with corruption. And these are periodically going to be a dampener on sentiment towards Nigeria, and it's kind of a battle between the two. But over the long term, I think the positive forces will probably win out, but it's always going to be quite tricky and volatile with Nigeria.
Jim, you also like Indonesia. So how do you rate Indonesia versus India?
That is a tricky call. I'd be positive on both of them. I think if I look at the largest emerging markets, which I'd sort of simplify by the brick and the mint countries, I'd have India and Indonesia together with China up there at the forefront of them. So I like both Indonesia as well as India.
And Teresa, what do you think about the attractiveness of Indonesia and India?
You know, we like Indonesia. I think Jokowi is going to have some trouble in getting through the kinds of structural reforms that he might want to get through, and that's because of basically the local politics. It's very complex and not easy to navigate. So I don't think we're very bullish on huge structural changes in Indonesia, but he'll probably be able to get some through. Our problem is finding the right company in our size range and with the high integrity sponsors in than Indonesia. But if we found that, Indonesia is a country that we would like. I'm not sure I'd compare it to India, because I think India fares so badly on the doing business index, ease of doing business, that there's so much low-hanging fruit to get in India. If you can get arbitration of a contract dispute down from 4 to 5 years to 3 years, that's a 20 or 25% improvement. That would be great. Winding up a business is impossible in India. Let's just make that possible. So many things would change if we can get some of those things through. So I think there's much more low-hanging fruit in India than in Indonesia.
My last question to you, Teresa, what do you think that the emerging market index will look like? And that's important because it will determine capital flows.
Is that a fair question, Punita? I ask you. My hope is that we will see recovery in the U.S., which is on its way, eventually followed by recovery in Europe. Japan, I would say I can't count on, well, I can't count on Europe either, but I can't quite count on. And I think that if those two anchors come back to health, we will see also the emerging markets become a little stronger. The emerging markets are growing, of course, much faster than the developed markets, so we do have that in our favor. But I think what I'm very hopeful for, I think the key is that more markets start reforming. So if we see Brazil go into reform, that would be fabulous. If we see Russia embracing a modernization agenda, that would, and maybe they have to, because they get their back will be to the wall. That would be fabulous. China is embracing a reform agenda. We just have to see where it goes. It's a tricky one that they're trying to do. And then South Africa absolutely has huge structural problems. Turkey's another country I think could be a phenomenal country if they embrace structural change. I don't see that they're doing that, but over the next 5 years I'm quite hopeful that we will see more countries embracing structural change, and that will be a new era of hopefulness in emerging markets.
And Jim, finally, what do you think the composition of the emerging market index will look like 5 years from now?
Different than it is today. I'm not sure what else I can say. You know, one would imagine that within 5 years, South Korea and Taiwan won't actually be regarded as so-called emerging markets. They probably will have gravitated to developed market status. So that will give space for other countries. And who knows? I think, even though I'm not in the asset management business these days, I've thought for years that conventional EM benchmarking and indices are pretty stupid anyhow. So I think the smart way to invest is to think outside the conventional box of EM indices. And if you can't do that, you're gonna confine and control and limit yourself as an investor.
Clearly, our guests believe that there's still opportunities in some of the emerging markets. While there are risks stemming out of tighter monetary policy in the US, the extent of the impact on each emerging market could be quite different. And so far as India is concerned, it is surely figuring in the top. And a big part of this is because of the hopes that are pinned on the new government and the reforms it has promised. Next week, we continue to discuss more global markets. Stay with ET Now. This is Global Insights with me, Punita Kumar Sinha. Thank you.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.